Hey guys, welcome back to season 1, episode 2 of our podcast, JMC Legacy Group Accounting and Tax. This is your host, Kendi Rodriguez, and today we're going to be talking about tax secrets every family and small business owner should know for 2024 in case you still haven't filed your 2024 taxes yet. So there's two different math equations we could use to qualify for the home office deduction. First, you actually have to have a home office where you work and that area is dedicated for working, creating content, producing income in your home. And the maximum square footage that you could claim is 300. And the simplified version is $5 per square foot. Now, let's say, for instance, you could also claim on the home office deduction if you own your own home. You do have like repair costs and maintenance. A portion of that can be written off if you're not going to use the simplified version. For example, you could gather up your utilities. How much did you pay for light? If simple math, let's say 10% of your total home versus your home office, 10% is used for 10% is used for your home office deduction. So 10% of what you've paid on utilities for light, you could claim that on your home office as a home office expense. Okay, so if you're going to claim like a cousin or a relative that's taking care of your child, it gets a little tricky because that relative would then need to also consider including that as their income when they come to filing their taxes. Okay. The dependent child has to be under the age of 19, and the expenses has to be qualifying expenses, meaning that if you're working a full-time job and you need someone to take care of your dependent, your child, in order for you to actually get to work, to keep your job, to produce income, then that is a qualifying expense that could be written off for the child care credit. So eligibility is the dependent has to be under the age of 19. The child, now if the child is over a certain age, let's say between, 12 to 19, and they have a need, like a disability where they can't be left alone, then, and again, you need to actually leave the child with someone in order for you to produce income. That is a qualifying event. Also, it can't be, let's say, the cousin has to be an adult. Yeah. It can't be a child watching another child, so that's not going to count. For example, I've had someone try to claim that a cousin was watching their little cousin. And when I asked, well, how old is the cousin? And I was told the cousin is 16. I'm like, well, that cousin doesn't qualify because it's a 16-year-old. So it has to be an adult that is watching the child. And that adult, you and that adult has to have some type of an agreement saying that I am going to report the income that I'm giving you to watch my child on my taxes, because you're going to need that person's social security number. And if that person refuses to provide that, then IRS could easily refute that as a qualified child care expense. So an agreement has to be made upfront before that happens. Common mistakes would be reversing numbers.
Like something that you've seen.
Okay, so what I've seen is reverse numbers where they will invert. Let's say, for instance, they wanted to save 1,500 and instead they put 5,100. That could be a red flag. Putting even numbers, like for example, putting everything $20, $50, everything an even number. It's instead of random numbers, it could be $51 instead of $50. That's also a red flag for the IRS, saying that all of these expenses come out to be even numbers. incorrect social security numbers that could kick back the return because the wrong social doesn't match with the date of birth and the person's name. Okay. Another example would be wrong filing status. You may have qualified for for head of household, and instead you're filing single. Well, you just missed a huge deduction because head of household deduction for 2024 is 21,900 versus single filer, the standard deduction is 14,600. That's a huge mistake. Yeah. So make sure to pay attention to that closely. Make sure to pay attention to date of births, social security numbers, and then that your expenses are actually real, true, legitimate expenses and not just round up numbers. They need to have a written receipt. So going back, like using receipt books or using a payroll system. That could be for babysitting. There's a bunch of different apps out there that would actually help you keep track of all of that. Even if you're paying them in cash, you want to create a log or some type of trackable event for you to be able to show proof that, hey, I paid this person in cash and this is how much that was paid. And also have a letter at the end of the year saying, I so-and-so paid so-and-so for babysitting and was paid a total of X amount of dollars for the year. And both parties need to sign. So that's also another form of documentation that you could use to be able to claim that deduction on the tax return. So, for example, if you're looking to claim the child tax credit, it is $2,000 per qualifying child under the age of 17. The requirement is that child needs to have a social security number. So if that child has an ITIN, they do not qualify for that credit. There's a lot of credits that a ITIN filer would not qualify for. So child care credit, the child tax credit are the two major ones that they would not qualify for. Even if payments were made in cash, they would not qualify for those credits. And those credits can be considered refundable, and they're only available to U.S. citizens or those with social security numbers.
What strategies can families and small business owners employ to maximize their tax deductions and credits annually?
Okay, so then now we're going into Schedule C, which is a tax form that's used on your 1040 personal tax return. You're going to have, if you're a small business owner, you're going to have certain expenses that you could actually deduct on your personal tax return. For example, if you're paying accounting professional, our fees are deductible because it's a professional fee. You're going to have capital losses, bad debt expenses. And I will go into a little bit more detail. So bad debt expense would be if you have someone that owes you money and that person never paid you within a certain time frame. Instead of chasing them down, you could file a 1099-C, cancellation of debt, and claim that as a loss, an expense on your Schedule C. Yes. So then donations to charity. Now, donations to charity this year, it does have a limitation up to 60% for certain donations, 30% on other kinds. The maximum that you could claim, let's say on a Schedule A, would be $500 without providing any more receipts or documentation. So if you've donated more than $500 in cash, or if you've donated items without a cash value attached to it, we used a fair market value instead for those type of donations. We do need to see receipts from those nonprofit charities, and they have to be a real, true nonprofit. There's a section on irs.gov that you could actually look up to see if they have a 503c nonprofit charitable status. And you would need the nonprofit's tax ID, nonprofit's address, and then a description of what was donated, and then your calculation of how did you come up with a value on those non-cash items. Yep. And then you have your medical expenses. That's 7.5% of your total AGI. That could be claimed on the Schedule A. So that would be for anyone that's outside of being a self-employed individual. Bookkeeping costs, bank fees, car mileage, health insurance. If you are paying health insurance through the marketplace, you could use that to write off on what you've been paying towards your premium. Other type of insurance that is needed: professional liability insurance, general liability insurance, workers' comp insurance, repairs and maintenance. So if you've had repair and maintenance costs on upkeep of equipments, you could even write off the equipment that you've purchased. Now, there are two different methods of using to write off your equipment. So you could depreciate the asset over a certain amount of years. Your tax professional would be able to explain which one would be best, because everyone's situation is different. Or you could fully expense out the purchase that year, but then you're missing out on the depreciation side of that equipment. What else? There's just so many other stuff. I went over bank fees, medical expenses, professional fees. It could be license and registration that you would have to pay for certain licensing based on your particular work, self-employment work, supplies, office supplies, office supplies and regular supplies. Office supplies would be paper, ink, other supplies you would need, like cost of goods, materials that would go on a cost of goods line, which is then subtracted from your gross. So then you'll have a net gross number. Then below that, you would have all the other expenses that I have mentioned. Interest payments on credit cards and loans, cell phone, utility costs, storage fees, and then you have your home office expenses, things that you could actually write off. And again, I had mentioned earlier, simplified version is $5 per square foot, up to 300 square foot of your home office. Or if you want to get a little bit more and see if it would be more advantageous for you to use a percentage. And again, it's going to be your total home square foot divided by the square footage of your home office. Simple math, let's say 10%. It comes out to 10%. So 10% of your upkeep of maintaining your whole home, that could be written off. I hope I went over everything. I'm trying to think if there's anything else I'm missing. It's a tricky question because my brain works on an individual case by case, and also looking out 2 years out. What is your goal? Are you looking to purchase a home in 2 years? Are you looking to qualify for a loan? It could be an SBA loan. It could be any type of financing, creative financing. So if you're someone that's looking out into the future and you're saying, hey, my goal is to qualify to buy assets, but I need to do it through financing, then there are certain expenses that can be moved to the depreciation side, claiming more on the car mileage side, that would help but not hurt you when it comes to qualifying for financing in the future. Now, if you're like, nope, I don't have any plans on financing or purchasing anything, I just don't want to pay any taxes, or want to pay as little as possible because it's really impossible not to pay taxes, then you would want to expense almost everything. You know, sometimes it makes sense to expense an equipment instead of depreciating that equipment. For example, now it has to make sense though. So it has to be necessary and ordinary based on your type of work, and it cannot place you in the red. Okay. So if you're operating in the red, that is a red flag for IRS because they're thinking, wait, you're claiming that you brought in this amount of income. However, you're saying that you spent all of this. Where did you find the additional income to be able to purchase all of this? It has to make sense. So I hope that answered that question. Okay. Best advice is to sit down with a tax professional. Yep. So sit down with a tax professional. That tax professional needs to be able to guide you and look beyond just at today's numbers and not care about, oh, let me try to generate a large refund for you. Because a large refund doesn't necessarily mean it's going to help you. It could hurt you. So first thing first, sit down with several tax professionals, ask these questions. You know, it's also looking beyond what are their skill sets? Like what else can they offer me instead of just filing my tax return? Because we do have, you know, unfortunately tax preparers that only work January through April, and then they're done and disappear for the rest of the year, only with their intention of making as much money as they can within the first 4 months of the year. So JMC Legacy Group, we do not operate that way. We're open all year round, and we love to sit down with all of our clients. We love doing tax planning. We love bring us a mess, and I like putting everything together, and then we maintain it for you. And we love educating our clients. Just want to say thank you for stopping by and listening to our podcast. Make sure to subscribe and share and like our podcasts. And, you know, feel free to give us a call. Our number is 980-447-9954. Send in your questions. Hey, even also if you have questions that you would want me to address on one of our podcasts, please comment below. We want to hear from you. Thank you, and see you next time.